Hello then, Business Tonight. Asian markets on solid footing today as investors speculate central banks might ease back on monetary tightening, cooling activity in the U.S. manufacturing sector last month, fueling hopes that the Federal Reserve could slow the pace of interest rate hikes. Now, those were further fanned in Asia after the Reserve Bank of Australia raised its key rate by a smaller than expected quarter percentage point. Well, in Sydney, the ASX 200 jumped nearly 4%, its best one-day showing since June 2020. But the Aussie dollar moving lower against the greenback. It is a similar picture, though, in the rest of Asia, the Nikkei 225 closing about 3% higher, recording its best session in more than 6 months. Coming back from an extended weekend, the Kospi rebounded to close about 2.5% up, and it rose as those chip makers were snapped up. Meantime, Singapore's STI ending the day in the green, up about 1%, while the Sensex also moving higher right now. Hong Kong and China markets, they're closed for holidays. Now, the market optimism also spilling over to Europe with U.S. stock futures as well, pointing to a positive start. But are global central banks about to slow the pace of interest rate increases? Joining us to share her insights is Alicia Garcia Herrero, Chief Economist of Asia Pacific at Natixis. Well, Alicia, why are financial markets pinning such hopes of just one central bank's smaller than expected rate rise? And why is the RBA's move so significant?
Well, RBA's move are always significant. I have to remind the audience that RBA was kind of the very first with New Zealand to hike and to move out of yield curve control. So in a way, we know that both central banks are kind of early movers, and this is a good signal for the world. It means that we could see, if not pausing, perhaps a slightly less aggressive hike, both for the Fed and the ECB. And this is, of course, related to the, interestingly, negative economic data that we received last night, but positive because it means that the Fed will do less. So, these are the two signals we have, which are moving markets positively. Less growth in the US, and in a way, kind of reaching a plateau for RBA.
Yeah, but in the U.S., Fed Chief Jerome Powell has been increasingly hawkish. So are investors and traders, getting ahead of themselves, given his tone over the past month, and not forgetting that we're still seeing high inflation across most developed economies?
Yes, you may say so, that, markets are looking for good news. We have only bad news, and anything that moves that looks like the Fed will do less will create, of course, a market party, if I may say so, risk on, because we have had so many days of risk off. And, just to remind the audience that we even had, a missile from North Korea today on Japan, and nobody seemed to notice. So, even geopolitical risk seems to be irrelevant. This is like the first for the last 5 years. Still, nothing happened. Why? Because everybody is looking for good news in the current very volatile and negative world we've been living for the last few months.
Well, Alicia, would you see today's move by the RBA as a concrete sign that interest rates are peaking, or from your expertise, what would be a more substantial sign that this is happening, we are peaking?
What I think shows, and rightly so, is that RBA is not going to follow the Fed, without looking at its own circumstances. The Australian economy is actually very strong. I mean, unemployment rate is very low. Housing prices continue to do well. There's nothing wrong with the Australian economy, but in a way, it shows that two fast hikes could hurt, even if not yet, could hurt the economy. So the RBA is just simply saying, I can continue to hike. I don't think this will be the last, to be frank, but I will do that moderately, and I won't scare markets. Again, when the RBA lifted the yield curve control, it actually did scare markets. It was, a risk off in Australia and huge volatility in Australian bonds. So So I don't think they want to repeat that episode. And I actually think it's very wise to do this, just not to do too much in one shot.
And just to follow up on something that you said, so stock markets, they were rising since last night's manufacturing data out of the US. Do you think this is a short-lived bear market bounce, given concerns of a looming global recession?
Yes, I'm afraid we may have bad news, basically moving us away from risk on to risk off. And that might come, unfortunately, from financial fragility. So we have a number of large banks, but also pension funds in the UK. I mean, any margin call, any problem with major financial institutions could bring us back to a risk-off environment because, again, we're not out of the woods. This was just one data point that moved the market because the market was eager to be in this risk composition. But I don't think it's going to last, to be frank.
Oh, many thanks for that, Alicia Garcia Herrero there from Natixis.